Wow. Welcome to the Stockout. This is going to be the last Stockout of the year, unless someone in production tells me otherwise. I'm Mike Baudendistel, joined by Grace Porch Pirate Sharkey. Just reading your article about the porch pirates. I never anticipated that wildlife would steal the packages, but I guess that's true if there's food in there.
Yeah. And maybe I took this right off a porch. Who knows? No, I specifically was like, I'm gonna make Mike laugh today. So it's Monday morning. I'm already winning. That's great to hear. And hey, I'm excited to be here. Yeah, we've got our last episode before the holiday season. A lot of fun stuff to talk about. A great guest as well. So it should be a nice episode here.
That's right. We have Ara Ohanian, CEO of Netstock. That's a company that produces supply and demand planning software, helps companies manage their warehousing and inventory planning needs. Also want to make sure everyone knows how to sign up for the Stockout newsletter. Just go to www.freightwaves.com/the Stockout. You can go up to newsletters at the top. Sign up for the Stockout as well as the other newsletters. And we've recently rolled out some new newsletters on the nearshoring, bring it home. And then you're doing one, Grace, on fraud. What's that one called again? Fraud Watch?
Good old Fraud Watch. Yeah, and it's
Fraud
I,
Watch.
I think the page is updated from what you see there. Fraud Watch should be like right near the top, right next to the Stockout as well. So easy to
Okay.
find.
We'll update that graphic next year. And I also want to thank today's sponsor, which is Nikola. Discover the future of freight transportation today. Visit Nikola's website to explore their zero emissions Class 8 trucks, transform your fleet, and lead the charge in sustainable logistics. Learn more at nicolamotor.com. Big thanks to Nikola. And I guess we should start by saying something about Albertsons and Kroger. I mean, we followed that so closely, when it was announced and all the trials and tribulations with FTC suing to block it. Catch you up if anyone hasn't been following this. Basically, the merger was blocked in a court in Oregon, so the FTC successfully stopped the merger. They filed lawsuits to stop the merger. Court thought it would lead to higher prices. Also thought that C&S, which is primarily a wholesaler, would not be a strong enough competitor. The C&S was the company that was going to purchase the divested stores. I think it was 579 stores were planning to be divested. And now Albertsons is suing Kroger. Seems like it has a multi-billion-dollar lawsuit here, for the $600 million breakup fee, which was in the contract. If Kroger were to walk away, it would have been entitled to a breakup fee. So it's unclear whether that's going to have to be paid, and then additional costs for legal fees and other things that they did to prepare for the deal. So it went from one legal situation to another legal situation. So is this good news for CPG companies? Do you think now that we're not going to have a merger of the two largest traditional grocery stores? I put traditional is important because there still would have been smaller than, let's say, Walmart if
Yeah.
that merger would have taken place. And does this perhaps discourage Amazon from buying another grocery chain that would add to its portfolio in addition to Whole Foods?
I mean, potentially, it's a really good point that you make there, especially in the Amazon side. I mean, the labor side of this discussion, I'm sure, is having a wonderful day hearing this, especially seeing the flip of the switch here into Albertsons now suing Kroger for this. But maybe the other side of me is thinking, well, we are going into a new administration that potentially could be a little bit, well, not potentially, I guess, too overwhelmingly for these types of mergers, right? But I will say, I think it's probably more than likely, yeah, you're correct. I think Amazon and others are probably questioning whether or not to go after this type of deal in the future. And at least, I mean, seeing how the new potential lawsuit could end up as well, that's adding icing on top of the cake too. So, yeah, a win today for, I guess, labor. Even though you and I discussed like whether or not this would be that big of a deal for those concerned about the unions tied up with this, yeah, not so good of a day for, especially for Kroger, you could say.
Yeah, and maybe a bad day for Albertsons too. I mean, Albertsons has really
True.
underperformed since this merger was announced. I think it was down 35% about since the merger was announced, whereas Kroger was up about 35%. Still has trailed the S&P, which is up like 60%. So there's quite a divergence there. Also, should touch on the freight market. So freight market showing additional signs of turning. A couple of good articles, I mean, sort of covered the same ground. One was written by Craig Fuller there that you see on the screen. And then Zach Strickland wrote a similar article, which went into a little bit more detail about some of the data behind it. But basically, sort of the bullet points are short spot rate, highest that's been in the past 2 years. There's Zach's article there. Tender rejection rates highest it's been since July 8th. More than the typical rise in tender rejection rates during that holiday period. And the tender rejection rates have risen while the volume has declined, both the tender volume and the accepted volume, which the accepted volume would not include those tenders that were tendered multiple times. And so the implication is that the capacity has declined in the industry. So because the rejection rates are rising while volume has fallen a little bit. And it seems to be supported by this 4% decline in trucking authorities, year over year. That's not always the best indicator of capacity, but maybe one thing that you can look at that supports that viewpoint. So what you're seeing on the screen now, the tender rejection rate rising, so that the higher the number there, the tighter the freight market is. You see that higher at 6.4% versus where it was a year ago, which is down at about 3.5%, sort of reaching its peak at about 5.5%. And that yellow line is tender volume, which you see that below where it was a year ago. And, Craig Fuller in his article talks about what this means for shippers, who, really the target of this show. It means it could create challenges for shippers in finding capacity next year. Shippers would be well advised to lock in contract rates, even at a little bit higher levels, just to secure capacity. And Grace, wondering if you had any other advice that you would give to shippers, since you have all this experience in the brokerage industry.
Well, definitely kind of running off of that note, as well as, we're starting to see, I think, this turn of a number of logistics providers, right, providing the technology available to see your capacity in a different light. I think that's, my biggest fear is that we might have shippers out there that we've talked about in the past. I mean, there's some very large ones that are still operating mostly off of either Excel spreadsheets or something with lightly in regards to that type of technology. And I think they're going to be overwhelmed by those who have invested in good tech and can actually see their capacity, know what lanes they're going to be struggling in, know where to spend that time looking for capacity, contracting that capacity to those certain lanes, and in continuing to improve on that throughout 2025 as well. And I'd hate to make this an obvious push, but I would go check out our top 25 freight tech winners from just a few weeks ago, because not only do we have providers, logistics providers within that list as well, who I would highly recommend looking out to, but we also have incredible technologies as part of that too, including Good Ship ISO's in there, who actually just recently was acquired by Triumph as well. And on that note too, others in there like Highway, right? So not only are you looking into your capacity in regards to who's going to be there as it tightens, who can you contract, who can you lock down, but are you locking down good companies, right? Like, are you actually looking at providers who aren't going to steal your freight at the same time, or who have earned the right to move your freight? Some of those really large shippers out there, you guys fortunately can hold yourself to a higher standard on the capacity that you are moving. So going into 25, making sure that you are knowing what lanes you should be looking into capacity, right? Not just shooting your shot in every single lane and trying to lock down the best, but knowing where you already have the best and knowing where you should focus your staff and your supply chain teams, I think will be huge. You're going to have a lot of supply challenges, I think, in 2025, whether it's tariffs and maneuvering around those, whether it's any type of regulation that's added with the trade partners you're using. It looks like, as of just minutes ago, emissions might not be that big of an issue for you out in California, but there's so many, I think, other pieces to the puzzle in a supply chain that could have different scenarios, whether it's regulation or tariffs, that you at least want to know where you need to attack your capacity. So I would say definitely look into the tech you're using. And if we have a second to talk about the next thing as well, maybe even the providers, right, that you're choosing to go on that journey with as well.
Yeah, so I want to talk about that next is
Yeah.
C.H. Robinson. So this is the biggest freight broker there is. Had a Wall Street Investor Day last week, and they don't have those very often. There is John Kingston asking CEO Dave Bozeman all the hard questions there.
I love
So
it.
this was the first one they had since 2017, the first since Dave Bozeman took over as CEO of C.H. Robinson. They raised their financial targets for fiscal 26 by about 10% above the consensus. So stock reacted positively to that, and wanted to bring this up. There you see the stock reaction up quite a lot from its low earlier this year. Wow, look at that, go from 70 to 111. And so bring this up for this audience because retail was one of the areas that they're focusing on. And in addition to that, C.H. Robinson is focusing more on small and medium-sized businesses. So I think a lot of that's just really applicable to the audience of this show. They're doing things like they said earlier. They ceded market share in that area, figuring they would lose it to some of these smaller startup brokerages. Some of those smaller brokerages have fallen on hard times. I mean, things like Convoy going out of the industry, and so they're redoubling their effort on the small and medium-sized businesses. Doing things like automated load, matching that went from 5% to 50%. They have these new tech processes in place. They're supposed to eliminate some of the friction with ship origin or origination processes, reducing the price to quote times. And so all this is supposed to help the company improve its margin. They're expecting the North American surface transportation margin to rise from 35% to 40%. But thought Jason Seidel, one of the Wall Street analysts that cover C.H. Robinson, put this really well, talking about C.H. Robinson's approach. He says it's an approach that blends human oversight with matching technology, another sign that the industry is stepping away from a tech exclusive platform. Customized service is back in focus. And so if you're a shipper, you probably want that customized service. And so you think it's a good time for retailers to take another look at C.H. Robinson.
I agree. And I think, CH as well, as a whole, has looked at some of its competitors out there. I think one particularly would be RXO, right? And how forward they've been on the tech side. But I think what CH Robinson, of course, has above the rest is that time and legacy in the industry. And I think retailers should be willing to hear that and listen to that. And I also think that might be a little bit of the issues that we've seen in the past with CH is maybe too tight of a turn towards tech, where you have these incredible leaders who are speaking up and saying, listen, you've got to have a different approach towards this in order to make these investments work. And we know that they've eliminated, I think, a lot of the, I don't want to say bad leadership, but just leadership that wasn't willing to maybe pivot towards that focus. And I think a lot of the leadership there is open and willing to hear out new technologies and implement it within that legacy of incredible, customer service and the human approach that they speak on here. They just announced last week, I think, that they're now partnering with Highway to give that security aspect, right, to the shippers. It helps out with as well. So I'm excited for CH. Again, I think some of the leadership there is really intelligent and just knows freight well, and maybe just haven't had the leaders from the above who want to hear that discussion and hear kind of that pivot into the human tech conversation. We've seen like the $1 billion investment they made. Again, I agree. I think they were like a little too strong on that approach. And now seeing, maybe instead of trying to like build all this tech in-house, we can partner with some of these incredible companies. And I wouldn't be surprised if we see acquisitions in the future as well. So C.H. Robinson, I think, is one that I definitely am excited to watch in 2025. And in what sounds like 26 as well, they've got some really incredible goals. So let's see if they can hit them.
For sure. It'll be one of the most watched companies, I think, of 2025, particularly from the financial analyst community. So with that, I want to bring on today's guest. It's Ara Ohanian, CEO of Netstock. Do we have Ara?
Yes, hi, good morning. How are you? And I must say, those glasses are terrific, Grace. I wish I had a pair.
I got them yesterday at my niece's Christmas party, and I said I'm gonna take these on the podcast, so I had to follow through.
Mike, do you have the matching ones?
Yes,
Oh
exactly.
no, no, I don't have matching ones.
Okay.
Well,
But
hey,
item of
I want to
care,
thank
right?
you again for joining us. I'm excited to have you on the show, and I think we've got a lot to talk about. Maybe let's start off with Netstock in particular. For our audience members that don't know, tell us a little bit about Netstock in particular and this survey we're about to go through.
Sure, absolutely. Netstock, as a company, what we are, we're an inventory and supply chain planning software company for small and medium-sized businesses. So, basically, if you look, our goal is to provide small and medium-sized businesses the tools and the AI they need to punch above their weight category and challenge and big enterprises. That's what we're in business to do.
Yeah, it's great. It's really important, and you deal with a lot of different industries, and some of the watchers of the show in the CPG industry, food and beverage, retailer. What are some of the sort of unique issues that those industries face, and what could they be doing better to manage their inventory?
Mike, interestingly enough, even those industries are not that different from any other industries when it comes to planning what stock levels you should have and how do you plan your forecast and your delivery. They're quite similar. Of course, there's differences occasionally in terms of lead times and things like that, seasonality. But basically, what you're looking today, if you look especially in the small, medium-sized business, so think of businesses under $500 million in revenue, 10 to $500 million. 90% of these businesses today don't have a forward looking software and AI that tells them what could happen, what should happen, and how they should plan for it. So they have no visibility because they're running their operational spreadsheets on forecasts that are done on an Excel spreadsheet. And I think that's where the real issue is. When you think about these businesses represent about 50% of our GDP, and three-quarters of new jobs that come about. So it's a huge part of the market, and they don't have access to software that shows them what the future could look like. Whereas large enterprises have data scientists, software, all kinds of stuff to predict what the future could be and how they should adjust to it. So the three industries you mentioned fall right within those same dynamics.
Mhm.
What's interesting too is just there's so many to look at like omni-channel. There's so many different channels that the companies of all sizes, right? Not just the big retailers, but those small companies, small businesses that are selling a few things. But there's so many different channels for them to sell to. So, can you really speak on the how do you gauge inventory in that type of environment where you have social selling platforms, you have, of course, like maybe Amazon providing platforms, but how have you seen the change in being able to manage inventory and understand what each of those channels could uh, potentially harm that inventory level over time?
Absolutely. Well, there's two situation one has to look at. One of them where a smaller business needs Amazon to be able to fulfill its business, or a big box like a Walmart, and there's no room for error. If those businesses aren't able to supply the right amount at the right time at the right price, they can be dropped off by those large distributors. So one of them is to be able to always make sure that you meet the SLAs of these large players so a business can continue. The second part is the independent channels that they create, omni channels that they support. For that, they need to make sure that they've got the allocation of the right investment in the right products. And I think that's where small businesses operating on spreadsheets and don't have an intelligent software that tells them how much of what product they should keep at any time, and also looking forward, how much should I have of a particular product at a particular time. That's where the really things can become very difficult. If you've got more dollars stuck in products that are slow moving and low margins versus the opposite, your business may be quite different. So you need to satisfy the big boxes and distribution, but you also need to be independently be able to allocate your investment where it should be.
Interesting.
Yeah, so a lot to consider there. Having to use one pool of inventory to satisfy just a lot of different requirements from different channels. I wanted to ask you also about just the market now in terms of just all the issues that have taken place in terms of, avoiding tariffs, the Red Sea situation. I mean, we've seen really strong imports, for this time of year. Really have seen it all year, but then it really hasn't slowed down all that much in the fourth quarter like it typically does. Have you seen your customers manage inventories differently to either avoid the tariffs or just for the longer supply chains, going around the Cape of Good Hope?
Absolutely, Mike. There are two situations. Tariffs are you plan around them. Red Sea or other such things are more like black swan events, and those you need to be able to react to them as quickly. So when you look at what our customers are doing and why they need a software to give them that visibility, that they can come in the morning and they can say, okay, well, how am I going to get affected by something I know? So let's look at tariffs. The natural thing that businesses do when they are not sure what to do, they say, oh, let me just get more stock. So if I have a lot more stock before the tariffs go on, then I should be in a better position. That's quite myopic and short-sighted, right? That doesn't work that way because you could do it once, but then what? So I think what we're seeing with tariffs are really suggesting a shift of supplier. And this is where one of the things that for our customers, because they have access to a supplier performance module where they can see which suppliers across their entire network are on time, on schedule, on money, and on quality. And so if you need to shift from one area and nearshore it to another, how do you do that? So one quick thing there to really note is that all these years, 30 years, China has become really good at providing product at scale and on time. Quality, of course, sometimes it's not been as high as one wanted, but those two things, when you shift more locally or on, that scale and that experience is not there. So knowing which supplier you switch to becomes critical. So that visibility is important. In terms of black swan events, like the ones that you mentioned, those are the ones if you're using your forecast as the basis to change what you should be doing in the future. Forecasts operate usually in quarters. So it doesn't need, that means it's going to take you, or sometimes monthly, it's going to take you a month to 3 months to effectively react. If you have a software that gives you the visibility into it that's risk-based, like our software will look every day, it will look at the next 365 days and what should your situation be so you can react a lot more fast, quickly. So two situations, one is reactive and the other one is planning.
So you touched on this a little bit, but I'm interested in a little bit more of the nearshoring trends that we're seeing. Do you feel like the customers you're talking to have already made that shift, are preparing for that shift, or are there some that are avoiding it altogether? What have you seen so far on your end?
Grace, actually, we just had some customer groups that we talked to see where their pain points are, what are doing, how we can be helping just last week, and a lot of interviews. And one of the things, obviously, they all realize they need to do something, and they're looking at alternate nearshoring opportunities. But depending on what industry you're in, it could be just a cost issue, or it could be an availability issue. So we're talking to one customer in the construction and building material supply, and they were saying, look, it's not just for us to nearshore. The thing is that if we nearshore it to the US and Canada, we've got 200 choices possibly of suppliers. We've been operating with 2,000 suppliers up to now that came mostly from the Far East and China. So I think the delta between going from a choice of 2,000 to 200 becomes huge because say we're not sure if we'll be able to fulfill our SLA on that. So they need to rethink some of their product mix. So one is availability. The other one is just cost. And so as you nearshore, some of the supplier may be higher cost. So you need to think that how that's going to be impacting the customer buying. And finally, depending if you are a part of a product that comes at the tail end rather than the front end of buying, the industry will spend all their money and absorb a lot of these higher costs. And when it comes to you to add the last thing, let's say tiles, if it's in construction, they construct and so on, the last thing you put in tiles. Now all of a sudden, that tile becomes much more cost elastic downwards, right? And so those are the kind of things that our customers have to work with.
Well, I think, Mike, overall, it shows we got a busy 2025 ahead of us, including for the team over at Netstock. Ara, where can people go if they want to learn more about the work that you're doing in supply chain?
Well, the first thing they can do, they come to our website, netstock.co. And what I would do if anyone's listening to this, start first download the benchmark. We have a benchmark report for free. We've interviewed 2,400 of our customers around the globe and asked them a series of questions about how they're managing anything from nearshoring, how do they finance their inventory, and what their lead time should be, and so on. And they can benchmark themselves against what others are doing. So I think that's a good place to start. And hopefully, if we can add value, then they might call us and see if we can help them with our technology.
Well, over from this interview, they'll realize the values there. Ara, thank you so much for joining us again. For our audience, happy holidays. Enjoy.
Happy holidays. Merry Christmas. Enjoy.
Yes.
Have fun with your families.
I love it. Make sure you guys go join our community. Head to newsletters at the top of FreightWaves.com so you can get that this week too. We'll be back after the holidays, though. I think actually it'll be the new year. So enjoy the next couple weeks. Check out FreightWaves.com for great stories. And until then, enjoy some shopping.